Listen closely because the financial event of the decade isn't happening on the stock market ticker tape. It's not happening in the Bitcoin charts, and it's definitely not being covered by the mainstream financial media. While everyone is distracted by the Fed's interest rate decisions and the latest tech stock rally, the plumbing of the global financial system is beginning to leak. And I'm not talking about a small drip. I'm talking about a catastrophic pressure failure that is building up in the one market Wall Street thought they had under control: silver. You see, for 40 years the price of silver has been managed. It has been suppressed. It has been kept on a leash by a paper derivative market that allows massive banks to sell metal they don't actually own. It's a game of musical chairs that has made a few institutions incredibly rich. But late last October, a new player entered the game. And this player isn't interested in trading paper contracts for a profit. They are interested in breaking the table. China has just set a trap for the Western banking system. It is a supply squeeze so calculated, so precise, and so massive that when it snaps shut in early 2026, it won't just send silver prices to record highs. It could trigger a failure to deliver event on the COMEX that exposes the insolvency of the entire paper money system. If you are holding dollars, if you are holding tech stocks, or if you think your bank is safe, you need to understand the mechanics of what is about to happen, because the smart money is already running for the exits. To understand the trap, we have to look at the bait. And the bait was laid in late October with a boring-sounding document called Announcement Number 68 from China's Ministry of Commerce. Most analysts ignored it. They thought it was just standard bureaucratic red tape. But if you read the fine print, you realize it's actually a declaration of economic warfare. Here is the reality. Starting this January, any company in China that wants to export silver must prove they produce at least 80 tons of the metal annually just to qualify for a license. Now, why is that number 80 tons so important? Because the vast majority of Chinese silver exporters are small to mid-sized operations. They produce 10, 20, maybe 30 tons a year. These are established businesses that have supplied the world for decades. With this one rule change, Beijing didn't just regulate them. They eliminated them. They disqualified roughly 90% of their silver exporters overnight. China currently exports about 4,000 tons of silver annually. That is 13% of the entire global supply. By implementing this rule, they are effectively locking that metal inside their own borders. But here is the twist that nobody is talking about. Last year, when the London silver vaults were running on fumes, when Western banks were desperate for physical metal to settle their contracts, who saved them? China. China exported a record amount of silver to London to bail out the Western exchanges. They played the role of the savior. They drained their own inventories to keep the Western game going for one more year. And now, just as the West has become dependent on that flow, they are shutting the tap off completely. So, why does a supply cut in China threaten a bank in New York? This is where we have to talk about the paper silver scam. The price of silver you see on TV isn't the price of physical metal. It's the price of a futures contract, a paper promise. The COMEX in New York is the casino where these bets are placed. In this casino, the big banks, the shorts, sell massive amounts of paper silver to drive the price down or keep it stable. But here is the dirty secret. They don't have the metal. For every 1 ounce of physical silver sitting in the COMEX vaults, there are roughly 400 ounces of paper silver traded. Think about the leverage there. 400 to 1. It works fine as long as everyone agrees to trade paper back and forth. It's a confidence game. The banks assume that investors will never ask for the actual silver bars. They assume they can always roll the contracts over, settle in cash, and keep the game going. But you can only short a physical commodity if you can eventually source the metal. If you sell 1,000 ounces of silver on paper, you eventually need to be able to buy 1,000 ounces of silver to close that position. Wall Street has been operating under the assumption that they can always buy that silver from the global market. They assumed China would always sell. They assumed Mexico and Peru would always sell. But what happens when 13% of the world's supply vanishes overnight? This brings us to the math of the collapse, and specifically, a number that is terrifying the risk management departments at major banks, $60.75. Why that number? Right now, the banks are sitting on massive short positions. They are betting the price will stay contained, but as the price rises, their losses mount. They get margin calls, demands to put up more cash to cover their bad bets. If silver breaks its all-time high and pushes past $50, it enters uncharted territory. But $60.75 is the estimated kill shot level. At that price point, the losses for the banks holding these short positions become catastrophic. We are talking about billions of dollars in losses accumulating in hours. Usually when this happens, the banks would try to short more to drive the price back down. They would flood the market with more paper contracts. But here is the problem. The market knows the physical silver isn't there anymore. If China locks down their supply in January 2026 and the industrial buyers panic, the banks cannot print more silver. They can print dollars, but they cannot print metal. If the price hits $60.75, the shorts will be forced to cover. That means they have to turn around and buy silver at any price to stop the bleeding. And when a short seller is forced to buy in a market with no sellers, the price doesn't just go up, it goes vertical. This is exactly what happened with GameStop stock, but on a global scale with a strategic asset that powers the modern world. And this is where the story gets even darker for the banks. Because unlike GameStop stock, people actually need silver to survive in the modern economy. We are in the middle of a massive transition to green energy. Solar panels are now consuming nearly 20% of the entire global silver supply. And the technology is changing. The new generation of solar panels, called TOPCon cells, are more efficient, but they use 50% more silver than the old panels. There is no substitute. Silver is the most conductive metal on Earth. You cannot use copper, it corrodes. You cannot use aluminum, it's not efficient enough. If you want a high-performance solar panel, you must have silver. China knows this. In 2024 alone, China installed more solar capacity than the rest of the world combined. They are building a green energy empire. By banning exports, China is securing that silver for their own factories. They are ensuring their solar panels remain cheap, while Western manufacturers, like those in the US and Europe, are starved of raw materials. Imagine being a solar manufacturer in Germany or Arizona in March 2026. You have orders to fill. You call your supplier. They tell you, sorry, China isn't shipping. You go to the open market. The price is skyrocketing. You look at the COMEX. The vaults are empty. What do? You panic buy. You pay any price, because the alternative is shutting down your factory. This industrial panic buying is what will break the bank's control over the price. We have to zoom out and look at the chessboard. This isn't just about money. This is about power. For the last few years, the BRICS nations, Brazil, Russia, India, China, South Africa, have been aggressively buying gold. They are moving away from the US dollar. They are building a parallel financial system based on real assets, not debt. Silver is the poor man's gold, but it is also the industrial man's oil. It is strategic. By squeezing the silver market, China is attacking the credibility of the US dollar system. If the COMEX fails to deliver, If a trader stands for delivery of silver and the exchange says, "We don't have it, here is a cash settlement instead," that is a default. It tells the world that the Western financial system is hollow. It tells the world that the price discovery mechanism in New York is a fraud. This is the same playbook China used with rare earth elements in 2010. They cut off supply to Japan over a diplomatic dispute, and high-tech Japanese industry ground to a halt. They proved they could weaponize the supply chain. Now, they are doing it with the metal that powers the 21st century. So, what happens next? And more importantly, what happens to you? January 1st, 2026. The export ban activates. The flow of metal stops. Q1 2026. The inventory data starts to leak. The market realizes the deficit is real. March 2026. The futures contracts expire. When the squeeze happens, we will see a transfer of wealth that will make 2008 look like a warm-up. The losers will be the institutions holding paper assets, the pension funds invested in banks that are short silver, the tech companies that can't source materials. The winners will be the ones who hold the physical asset. But there is a danger here too. When the price breaks $60, $70, $100, the rules will change. The exchanges might raise margin requirements to force the little guy out. They might suspend trading. They might force liquidation only. We saw this with the nickel market on the LME a few years ago. When the price exploded, the exchange simply canceled the trades to save the Chinese tycoons who were short. But this time, the roles are reversed. It is the West that is short, and China that holds the physical cards. And China won't agree to cancel the trades. The trap is already set. The door is closing. China bailed out the West in 2024 and 2025. They played the nice guy. They kept the prices low. They let Wall Street build up massive short positions, thinking the cheap metal would flow forever. Now they are walking away. When the industrial buyers realize they can't source physical silver in 2026, the repricing will be swift, brutal, and permanent. The smart money isn't waiting for CNBC to explain what happened. They are looking at the supply data, the export bans, and the empty vaults. You have weeks, not months, to understand this story before it becomes obvious to everyone else. The question is not, will the price go up? The question is, will you be able to get any metal at all when the panic starts? Look, I'm not here to give you financial advice. I'm here to show you the data that the mainstream news is ignoring. China has made their move. The trap is set, and Wall Street is currently staring down the barrel of a $60.75 price target that they cannot afford to hit. History is being written right now. You can either watch it happen from the sidelines, or you can prepare. If you want to follow this story as the squeeze tightens in 2026, make sure you hit that subscribe button and turn on notifications. I will be tracking every single update on the inventory levels and the export bans. Trust me, you are going to want to see what happens next. Thanks for watching Finance Wealth Money.